I want to demonstrate how to calculate cash flows, which is the main objective of Chapter 8. And I will be working the espresso stand project that I handed out on Friday, May the 17th. So, just to give you a quick overview of what I talked about very briefly at the end of class on Friday, when you're calculating cash flows, you can break them into three main categories. The first are essentially the startup costs, and I'm not sure I called it exactly that last Friday. Some books may call it the initial cost or initial investment. So it's basically money you need to spend at the beginning to get the project off the ground. And in the Espresso project, the outflows will only take a year. It will only take us a year to get the project off the ground. But there could be plenty of projects that have multiple years of outflows in a row before ever receiving any inflows. So startup costs happen first, and then eventually the project gets underway and begins operations, and so we calculate operating cash flows. And then finally, at some point, even if you expect the project to continue indefinitely, we want to stop estimating yearly cash flows and just lump all those future cash flows into a single ending value that they call the terminal cash flows. Or maybe I'm planning to sell the company to another investor after 5 years because I tire of the project, or I want to retire, or something of that nature. Or maybe the company gets bought out, or the project gets bought out by another company. But essentially, if you look at the Espresso Stand project, I've broken the given information into three parts: the startup cost, the operations, and terminal value. So when I am inputting values into this spreadsheet, I'm getting all those values from that handout I gave you last Friday, which will also be on the course website. So what I'm going to do is start essentially calculating an income statement, more or less. And I'm going to separate my cash flows by the time that they occur. So this project is expected to last for 3 years, and then at the end of the third year, I plan to sell it. I before I can open my doors for business, need to purchase some land and some permits. Under Part A of Startup Cost, it tells me that that is $10,000. So I'm going to start just tracking things. So purchase land and permits, and that costs $10,000. So I'm putting it as an outflow at time 0. Now, presumably, the permits would be tax deductible, which would save me some money on taxes, but I don't know exactly how much of that is permits and how much is land. Land, however, isn't depreciable, so I just will have this $10,000 outflow, and I will never be able to write any of that cost off. So I'm just going to assume the permit costs were very low, and I'm not going to worry about the tax associations or any taxes associated with that. I also, in Part B, under Startup Cost, will purchase a building, and it tells me that will cost $15,000, so I'm making it an outflow, and that it's also depreciable. So I just need to remember that this is depreciable. And I'm going to write it off using straight line depreciation over a 15-year time period to a salvage value of 0. So I'm not quite ready to deal with depreciation yet, but I will in a little bit. I plan to hire and train employees for a cost of $2,000. I didn't spell that right, did I? Now, I'm going to put that as an outflow. The interesting thing about certain expenses is some of them are deductible the year they occur. Others are only deductible at future points in time. So training your employees would be something that you could deduct right away for tax purposes. So it would essentially save me money in taxes in the year that it happened. Whereas purchasing the building, the IRS says you cannot deduct the entire cost of that building the year it occurs. You instead get to deduct it in small increments over the next 15 years. So the tax benefits associated with the deductions won't happen until years 1 through 15 for the building. The tax benefit of the deduction for training your employees will happen the year that it occurred at time 0. I'm going to take a little side trip over here and just talk about the tax benefit of the $2,000 deduction. Let's say my income, and it's not $10,000. I'm just making these numbers up to show you something. So let's say my income is $10,000 and my deduction is $2,000. And so my taxable income will be the difference between the $10,000 and the $2,000. So my taxable income, $8,000. And let's say my taxes are 30%. Actually, let's use 40%. Nope, 20%, because that's the rate I'm using in the project. Well, if I have taxable income of $8,000 and my taxes are 20% of that, I will owe $1,600 in taxes. Now let's go over to here and let's look at another company that doesn't have a $2,000 deduction. So they have no deductions at all. Their taxable income would be the $10,000 minus 0 deductions, or $10,000. And their taxes would be that $10,000 times the 20% tax rate, $2,000. So essentially, because in column H we have a $2,000 deduction and taxes are $1,600, whereas in column I have no deduction and taxes are $2,000. The difference is $400. So that $2,000 deduction resulted in a $400 tax savings, which is a good thing. So ultimately, even though I had an outflow of $2,000, I had a savings of $400, so that $2,000 expense after taxes only cost me $1,600. The easier way to figure that out is to say, okay, I've got a $2,000 expense. If you multiply by 1 minus the tax rate, it will calculate your after-tax cost of the deduction. The $2,000 deduction itself and the $400 tax savings. So down here, I'm going to, instead of putting $2,000, I'm going to put $2,000 times 1 minus that 20% tax rate. So if it's a tax-deductible expense, the after-tax cost will be less than the original cost. This is a tax-deductible expense, but not this year. So its deductions happen in future years, so I will deal with that once I get to year 1. Okay, I also am going to buy some inventory. And in part D of startup cost, it says that was $3,000. But it also told me I was going to finance 2,100 of that inventory in purchase with accounts payable. And that's 2,100. So what I really care about is how much my cash has been impacted by this working capital adjustment. So again, I can sum my current assets except for cash, subtract the sum of my current liabilities, and that will tell me how cash has been impacted. So $3,000 purchase of inventory minus the $2,100 increase in accounts payable tells me that my cash had to decline by $900. Essentially, I bought $3,000 worth of inventory, but I only borrowed $2,100 through accounts payable, so I had to pay $900 in cash for the rest of it. So I will call that change in working capital. And so inventory minus my accounts payable. Now, what I really care about is the change relative to the preceding year. But the preceding year I hadn't undertaken this project yet, so the change in working capital associated with this particular project was 0. So what I'm going to do is calculate what they call incremental working capital, where I take the current change in working capital and I subtract the preceding year's change in working capital. But since this is the very first year of the project, my preceding year had a value of 0. But in year 1 it won't. You'll see how that flows through. Eventually I want to total all of this, or some of it, but I'm not quite ready to do that yet. I have some more items I want to add here for years 1 through 3. Once I get all of those incorporated, I will tally my final value for cash flows. So now it's time to start my operating cash flows. So if you look in the section called Operations, you can see that I expect to sell 75 items a day at an average price of $3.50 each. So I'm going to just add an item here, unit sales, and it's 75 units a day. So I'm going to go 75 times 365. Or no, it says the espresso stand will be open 360 days a year. So 75 units a day times 360. I expect to sell 27,000 units that first year. And then my unit price was $3.50. And so my total sales or revenue would be the number of units I expect to sell times the price per unit. So 94,500. Oops, that's the wrong year. That's year 0, and those don't occur till year 1, so I'm just going to move it to year 1. Fixed costs are expected to be $13,000 a year, starting in year 1. So I am just going to copy that across through years 1 and 2. And then it says variable costs are $1.25 an item. So it's going to be 1.25 times the total number of units I expect to sell, 27,000. So variable costs are $33,750. Depreciation now needs to be considered because I can depreciate that building and that building cost me $15,000. I'd rather it return a positive depreciation figure, even though I know depreciation is a deduction. I will deal with that when I create my final formula. So my depreciation is 15,000 total, and it's being written off on on a straight line basis for a 15-year period. So I'm just going to take that $15,000 divided by 15 years. So I'm writing off depreciation of $1,000 for that building every year. Oops, I need to make B9 an absolute reference, then copy it. So I'm writing off that $1,000 depreciation every year for 15 years, but I know that my project, I plan to sell it at the end of year 3, so I'm stopping in at 3 years. It also, I know somewhere in there, I don't see it, just a moment. Oh, in Part C. In Part C, it says that I plan to purchase an additional espresso machine for $2,000, and the machine will be depreciated over a 4-year life using straight line depreciation. So up here, I'm going to add a new row, and I'll just add new espresso machine, and I will put that outflow in year 2. But the thing about the espresso machine is, oops, 2 things. One, it's $2,000, not $1,000. And 2, I don't get to deduct the cost of it in terms of tax related issues the year it occurs. I spend the $2,000 on it, but my depreciation occurs in years 3, 4, 5, and 6. So I won't actually start receiving tax benefits from the deduction of that espresso machine until years 3, 4, 5, and 6. So I'm going to go depreciation, espresso machine, and starting in year 3, I am going to write off the cost of $2,000 divided by 4, because I was writing that machine off over 4 years. So again, even though the outflow occurs in year 2, and that is the year I put the outflow, the tax effects don't occur until the following 4 years. So now I can calculate my EBIT, earnings before interest and taxes. You might know it as operating profit. I'm actually going to start with year 1. So my operating profit would be my sales minus my fixed costs, minus my variable cost, minus my depreciation. And even though year 1 has no depreciation in my row 22, I'm subtracting it anyway because I want to copy this formula across. And in year 3, there is a value in row 22 for the espresso machine depreciation. So here is my taxable income the first year, and I'm going to copy that across, although I haven't quite finished up here yet. So let's fill in this part. It says in Part D, under operations, that sales are expected to rise by 20% in year 2. So I'm going to take year 1's sales times 1 plus the 20%. And an additional 25% in year 3. So I'm going to take year 2 sales multiplied by 1 plus the 25% to get unit sales for year 3. And it doesn't give me any information about the price per unit, so I'm going to assume it stays at $3.50 a unit. And I can copy the sales formula across to get sales, and it will multiply price times units. Variable cost, I can copy that across as well. So it's taking $1.25 times the expected unit sales for years 2 and 3. And if it had told me that we expected these costs to rise by the rate of inflation or something even higher or lower than that, we would have made changes to those as needed. So now I do have the correct figures for EBIT, but I think I'll go ahead and finish this part first. Um, the thing about EBIT, well, first actually let's calculate taxes, and we were told that was 20%. So this is earnings before income and taxes is what EBIT stands for. So I need to subtract, I said that wrong, it's earnings before interest and taxes. So I need to subtract taxes, and you'd think that I need to subtract interest as well, but the cost of interest is essentially a cost of financing. When I borrow money, I have to pay interest on it. So interest represents a cost of financing. Rather than considering that cost of financing in the cash flow calculation, instead we consider it in our discount rate calculation. If we have high cost of borrowing, that increases our discount rate. So essentially, the cost of financing is the hurdle rate we have to exceed. So when I'm calculating the net present value, I will discount by that hurdle rate. And if I get an NPV that's positive, it means it's exceeded that hurdle rate. It's exceeded those costs of financing. So it looks like the project is a good idea. So even though this is interest before interest, earnings before interest and taxes, I'm not actually going to subtract interest because that will be dealt with in that discount rate. But I do need to subtract taxes. So I take my EBIT, multiply by my tax rate of 20% to estimate the taxes that I'll owe on the income in row 23. And this will give me my expected net income. So I'll take the EBIT, subtract the taxes to get my expected net income. Now, this depreciation is not actually a cash outflow that I pay anybody, nor is that $500 depreciation in year 3. I paid for these assets. I paid for the building in year 0 where it's an outflow. I paid for the espresso machine in year 2 where I have it as an outflow. So these depreciation numbers are not actually cash outflows that I pay to people in the year that I have them listed. They were actually paid at time 0 and at time 2. So, but I do want to deduct them because it saves me money on taxes. So for instance, if I didn't have this $1,000 as a deduction right here, I'm going to delete it. Watch what happens when I delete that. Watch what happens to taxes. So I will just highlight that cell to call your attention to it. So right now it's $93.50. When I delete that deduction, it goes up to $95.50. So by having that deduction of $1,000, it has saved me $200 in taxes. That's the cash flow aspect of depreciation that I do care about. The fact that it saved me $200 in taxes in the year I wrote off that depreciation. But the depreciation itself wasn't actually a cash outflow in the year I have it listed. So I'm going to add it back in the year that it occurred. So what I actually want to do is sum these two depreciation rows and add that depreciation back to net income to get my cash flows. So I'm just going to copy that depreciation formula across. There's a little bit more I need to fill out up here before I come up with my final cash flow figure. I need to deal with some extra inventory. So in part E, under operations, it says inventory is expected to have an average balance of $3,500 in year 1, and accounts payable an average balance of $2,450. And for years 2 and 3, inventory and accounts payable will rise at the same rate as sales. So in year 2, sales were expected to go up by 20%, so inventory would rise by 20% as well. So I'm taking the previous year's inventory, increasing it by 20%. Same thing with accounts payable. Previous year's accounts payable, increasing it by 20%. In year 3, I will take the previous inventory, increase it by 25% this time. Previous accounts payable, increase it by 25% this time. So now if inventory goes up by $3,500 and accounts payable goes up by $2,400, that means cash will drop by $1,050. But relative to the previous year, it's only dropping by an extra $150. So I calculate the incremental working capital by taking the change in working capital and subtracting the change in the previous year's working capital. And I actually subtracted the wrong thing. I need to take change in working capital for the current year, subtract the change in working capital for the previous year. And then I can copy that across. And this is the working capital number that I care about, my row 15. So the first year, big drop in cash because of the huge inventory purchase, going from no inventory to $3,000 in inventory. The second year, only an extra $150 drop in cash because inventory rose not from 0 to $3,500, but from $3,000 to $3,500. So inventory rose by $500, accounts payable rose by $350. Essentially, the difference is $150. That $500 increase in inventory minus the $350 increase in accounts payable. So down here, I can now calculate my net operating cash flows. Actually, I think I'm just going to call them net cash flows because I'm grouping, I'm going to do terminal cash flows and everything. I will start with year 1. So year 1, I would take my net income, add back my depreciation, and subtract my incremental working capital. Plus, I would add any non-operating cash flows that might have occurred in that particular year. In year 1, nothing associated with non-operating cash flows occurred. But in year 0 and year 2, it does. Didn't like that. I just forgot to close my parentheses, it looks like. And I need to put the word sum in front of that. There we go. I will do it again over here. So for year 2, I could just copy this equation over, but I messed up a little bit and I want y'all to see it again. So for year 2, take my net income, add back my depreciation, subtract my incremental working capital, and add any non-operating cash flows that occurred in year 2, which would be only the first 4 rows. And don't forget to put your parentheses after it. So 45, 9, 10. And I am just going to copy that over so you can see that it gave you the same answer. And now I can just copy this one over too. And if I did everything right, I can just copy this equation over to year 0 as well. So for year 0, I've got, just a second. When I record these videos, it blocks the most, the part of the screen that I use to zoom things. So I am going to go down to, I guess, 175% because I want to see a little more of the screen at once. But for year 0, it's considering the purchase of the land, the building, training my employees, and I've already dealt with the tax effect from training those employees. It's dealing with my incremental working capital, and I don't have any operations. So even though it's highlighting those cells, there's nothing in them. So it's basically not impacting my answer. So in year 0, I've got a big outflow of 27,500, and the inflows are expected to occur in years 1 through 3. So I have now calculated my startup costs, my operating cash flows. I need to deal with my terminal cash flows. And under terminal value, it says at the end of year 3, you plan to sell the espresso stand for a price equal to the free cash flow, assuming it grows at an annual rate of 2% forever. So essentially, this cash flow right here, if I sell the project, I'm going to charge a price of a perpetuity, a growing perpetuity, equal to this number growing at 3% forever. I'm going to zoom in again because I just think it's a little easier for y'all to see on these videos when I'm zoomed in. So my terminal cash flows, I'm going to insert a comment, and so we'll assume year 3 cash flow grows at 2% forever. And you can do show hide comments to activate that comment. Just off to the side over here, I want to talk a little bit about the growing perpetuity formula. Remember, the growing perpetuity finds the present value, and I would take the cash flow divided by the required rate of return minus the constant growth rate. This, though, I need to assign time periods to things. This cash flow, when we've worked it in the past, we normally had the first year cash flow, and that would find the value the year prior to that numerator, year 0, if this was the first year cash flow. But the 62,485 isn't the first year cash flow, it's the third year cash flow. And actually, it said that it was equal to that amount, and it was expected to grow at 2% forever. So I need to take the first year it's expected to grow by 2%, which actually is year 4. So I need to find a cash flow in year 4, and then I would take that number, divide by the required rate of return minus the growth rate, and that would give me the answer 1 year prior to the numerator over here. Since my numerator is at time 4, my answer is going to be at time 3. But first I need to find the right numerator, and I'm going to do all of this in a single equation. So my numerator would be my year 3 cash flow, grow it by 2%, and then divide it by my required rate of return, which is given at 15% under additional information, so 0.15, minus the growth rate of 2%, which was given under terminal values. So I've got my cash flow at year 4 that I've calculated by taking year 3's cash flow, growing it at the 2% rate, divided by the required rate of return minus the growth. And again, that will give me the answer 1 year prior to my numerator. So it will give me the answer in year 3, which is why I popped it in column E, because column E is year 3 stuff. So my terminal cash flows are expected to be in time $3, $490,000. So I can calculate my total free cash flow for each year by just taking the net cash flow and adding any cash flows that occurred for terminal values, which only actually happens in year 3. So here's my free cash flow. And then I can find the net present value using the NPV function, and my rate is at 15%. Just double checking. There, yep, 15% is my rate. And my values that I want discounted, I start with year 1, highlight through year 3, including that terminal cash flow in there, which is built into cell E29, and then add my startup cost in year 0 outside the parentheses. It will actually subtract them because it's a negative value. It thinks it's a percentage, so I format it as a dollar amount, and there is the net present value of this project, $404,000. What I'm going to do in the next video is incorporate risk analysis from Chapter 9. And I'm going to use the same project because you're already familiar with the project, and it's a pretty simple project. It's short. We know that we expect to sell this many units. And I think what I'm going to actually do is I'll put daily units up here. And that was 75, and then 75 times 1 plus the growth rate of 20%. And then the previous year's units times 1 plus the growth rate of 25%. And then down here in unit sales, I'm actually going to create a link. I'm going to replace that 75 with a link to the cell that has 75 in it. And I will actually do the same thing there. So now I've got links to the cells above. Because when I go to analyze the project for risk, I think I want to change those daily units as part of my risk analysis. And it's just a little easier to do if I have them broken down into separate cells.